Thanks for tuning into Talking Point. I'm your host, Niraj Shah. As much as I thought that the Q3 earnings season was turning out to be much better than anticipated, a note from Motilal Oswal Research made me wonder if my thesis was correct. And they're pointing out of the kind of performance that has happened within their coverage universe makes me wonder about some of the larger names and where is it that the misses have happened and what could be the implications of these over the course of the year 2023. Joining me on the show today will be Gautam Duggad, and we will talk to him about 4 or 5 key aspects about what's happened in the earnings season. So, which heavyweights are holding fort in an inline earnings season, if you will? Can mid caps see some traction in select pockets of outperformance? We'll ask him which sectors have both earnings growth and valuation comfort, if at all. We'll specifically talk to him about whether ITC can give strong returns after such a strong run up already. Cement has been a bit of a mixed bag. Is he constructive there? And of course, which stocks are on Gautam's radar? So these are the conversation points today. We will, of course, not mention here, but talk to him about the internet businesses as well. He joins us right now on the show. Gautam, great having you. Thanks for joining in.
Thank you. Thanks, Niraj.
So, Gautam, I read your note with interest. You don't seem that happy with the earnings delivery this quarter.
Yeah, Niraj, actually, you are right. See, sometimes the aggregates give a very misleading picture, and the spread and depth of the earnings are weak this time, in my view. A number of sectors which are muted in terms of earnings performance are much higher this time. I mean, see, we are all used to banking and financials leading the aggregate earnings for last almost 5 6 quarters now. FY22 banking and financials did very well, but commodities also supported, right? In FY23, commodities have completely lost, because of commodity prices and then export duty, whatever reasons. Commodity earnings have taken a big knock. It's been compensated by auto to an extent, but the profit pool contribution of auto is hardly 5 6%, whereas the profit pool contribution of metals and oil and gas is much higher, almost 20 25%. So what we are losing out because of commodity is not getting recouped by other sectors. So when you look at aggregate picture for Nifty, it still is in line. I would say, if you look at this quarter earnings also, we are roughly talking about a 10 11% kind of an earnings growth versus expectation of 12%. And for our broader coverage universe, the earnings are absolutely flat so far versus our expectation of 8%. And this is still yesterday. There are about 188 companies in our coverage universe which have declared earnings. There are 43 Nifty companies which are done with the earnings. If I look at the positive side of the equation, then if you just look at the numbers excluding commodities, the growth is somewhere about 30%, which is marginally better than expectation, both for our coverage and Nifty. If I want to point out problems, then I would say you look at numbers excluding financials. Then if you exclude financials, there is an earnings decline actually, right? Both for Nifty and my coverage universe. So on one hand, you have financials, which is single-handedly lifting the earnings. And on the other hand, there are commodity sectors, including metals, oil and gas and cement, which is single-handedly bringing down the aggregates. And then my broader problem, if you delve into the details and granular aspects of the corporate earnings this time, is that X of Nifty, rest of the broader market, whether you see our coverage or some of the other broader indices like BSE 500 or NSE 500 maybe, there the slowdown is quite evident in the sense that X of Nifty, rest of the aggregates put together are showing a very, very weak picture, which is why we titled the report by saying that earnings are in line, but it is led by the big ones, which is what is holding the fort.
Sure.
And one of the things, during the course of our discussion, we will discuss is that there is a very clear consumption slowdown, which is evident in the numbers.
Wow. Okay. So let me dwell on the negatives first. Where is it that, and then we'll talk about the consumption slowdown, which will be a part of this conversation. But first, where is it that the numbers have been weaker relative to your estimates? What pockets?
Sure. So the big one is metals. We were, I mean, just to give you an absolute picture, because percentage sometimes do not give you the context. So for metals companies which have announced numbers so far, there are 7 companies in our coverage which have announced the numbers. Roughly, we were expecting profits of 24,000 crores. The actual number which got delivered is 12,000 crores, so almost half of that. We were expecting a YOY decline of 20%. We got a YOY decline of 60%. So this is a pretty big decline in that sense. Second is oil and gas, and oil and gas, as always, is volatile because of the OMCs. So if you look at oil and gas, we were expecting a roughly 25-27% kind of a YOY earnings decline. We've got a 35% decline. Then rest of the sectors are small in terms of their overall impact on the aggregate earnings pool, but at the margin they are creating a negative impact. One is cement. By the way, cement is now the fifth or sixth consecutive quarter of a YOY earnings decline. So this quarter again we are seeing a 21% YOY earnings decline, which is, you can say, in line with expectation, but that doesn't help. Then you have seen a very muted set of numbers from pharma for the fifth or sixth quarter now, where earnings are of hardly 5-6%, and spread of earnings is very bad. You saw some of the big ones disappointing, Lupin, Divi's. The only company within pharma, I would say, which have met expectation is Cipla, and to an extent, no, even Cipla disappointed. I think it is Sun Pharma which has delivered in line with expectations. So pharma, cement, metals, oil and gas, these are the 4 sectors which have created a negative drag on the aggregates. Consumer, while it has met expectations, but expectations to begin with were very muted. So we were expecting a 8% profit growth in consumer. We've got about 10%. So you can say it has met expectations, but it is still very muted, I would say. So what a surprise then. It is auto and financials. So to address your question, these are the 4 or 5 sectors which have been a bit disappointing in that sense. But Niraj, let me reiterate, in Nifty, you have still not seen any meaningful earnings downgrade. When the quarter began, at the time of preview, we said FY23 EPS will be 820 rupees. Right now, we are saying 810 rupees. So just 1% cut. And if you again do a slightly deeper deep dive, you would find that entire cut in the Nifty EPS has happened because of metals. So I was projecting a profit of 6.5 lakh crore for FY23 for Nifty. Now we are at 6 lakh 40,000 crores, right? So roughly you can say about 10-11,000 crores kind of a difference. And entire difference has happened because of metals. So the metals number we were projecting for Nifty was 40,000 crores. Now it is 25,000 crores.
Got it.
So the total 11,000 crores cut in Nifty, out of which 15,000 crores has come from metals. So that basically means that rest of the sectors like auto and financials have actually seen an upgrade, minor upgrade, right?
Okay.
So picture is, slightly muted, but you have to take a slightly nuanced approach to understand sectoral level implications.
So let me try and flip this a little bit and ask you, with what, where is it that you believe the disappointments are likely going to be short-lived, if it's possible to predict? And within autos and if financials, is there a possibility of continuation of this positive momentum? And of
Yes.
course, what are the names within that bucket that you believe have done well or not done well and could reverse?
So let
Earnings,
me
purely
answer the
earnings.
easier question first. I think financials and auto should continue this momentum, because in auto you are seeing things changing after 5 years, and in banking you've seen things continuing to do well, right? I mean, one of the number I keep highlighting in every interaction of ours is the banking profits. Let
Yes.
me repeat that. 45,000 crores was the financials profit in Nifty in 2018, right? We will end FY23 with 2.1 trillion rupees. So 5x profit jump in 5 years, which is a very strong, consistent track record. And even visibility next year for FY24 for financials earning at about 17-18% growth is there. So you can predict with some certainty that this number is doable, because we have seen upgrade in banking even in this quarter. despite the pressure on deposits which might come in FY24. Second, auto is the exact reverse case. When banking sector profits bottomed out in FY18, auto sector's profit topped out. So FY18 auto sector profits in Nifty were 30,000 crores, roughly. From there, that 30,000 crore number has gone down to just about 8,000 crores in FY22. And this year, we will do about 25,000 crores. Right? So there is obviously a huge element of volatility because of Tata Motors. But even aside of Tata Motors, over a 5-year period, auto profits are down. Right? But at the margin, things are changing for auto. For example, this quarter, we have seen an upgrade in auto across the board. Maruti numbers were upgraded, Bajaj Auto numbers were upgraded, Tata Motors has seen a decent upgrade. So auto profits for FY23, we were projecting at 20,000 crores when the quarter began. Now we are saying 25,000 crores for this year. And our expectation actually for the next 2 years is for this profit to double. Now,
Wow.
obviously, things can change because
Sure.
there are 3 different moving parts in auto: demand, supply, and commodity prices. Right now, all
Yeah.
3 look changing towards the better. Right now, to answer your question, which are the companies within the space? In auto, for example, we are seeing very strong trend in PV and CV. Two-wheeler is still muted. You saw numbers of Bajaj Auto on a monthly basis. Hero monthly average volumes are still at a flattish level on a 8-10 year basis. So whatever improvement in auto that you're seeing is largely driven by passenger vehicles and commercial vehicles. And banking is across the board. PSU Bank, private sector banks, NBFC, all of them have come to the party. Credit growth is picked up. Your margins obviously is now peaking out on an NIM basis because banks which were doing a margin of 4.1, 4.3% 5 quarters back are now at 5.2, 5.5. So I think there will be some moderation in NIMs going forward. But because the asset quality is so strong, you might still see continuation of a 15, 17% kind of a profit growth. So both these sectors, you will see momentum continuing. Where I have no clue is on commodities because they will depend on where the commodity prices settle. And there are multiple moving parts there too, globally, on China, on geopolitical headwinds. So commodity profits in the best of the times are unpredictable. And right now we are living in a very volatile and disruptive time. So I won't hazard a guess. We generally mark to market commodity earnings. Like I
Yeah.
said, this profit, when the quarter began, we were projecting 40,000 crores. Now it is at 25,000 crores for FY23.
Got it. Gautam, there is a belief in certain quarters of the market that banking, just on the lines of what you said, and because of, and if there is a peaking out of the interest rate cycle, which was expected this time, didn't happen, maybe it happens in April. Do you think that there could be a shift, not necessarily out of banking, but in some fashion, a slight deviation towards NBFCs versus just pure banks? Is that a call that you would make as well?
Yes, it is quite possible and very logical to think like that, Niraj, because if interest rate cycle peaks out, generally NBFCs tend to benefit on the cost of borrowings and therefore spread and margins. Second, NBFCs have underperformed in this rally, right? Across the board, actually. The other angle is, Niraj, if you think some of the reallocation of money could happen because banking is a consensus overweight sector. Every fund is overweight on bank, which is why for 2 quarters now you have seen that despite good results from banks, stocks haven't moved up. Whether it is ICICI Bank or Kotak Bank or Axis Bank for that matter. While numbers have been extremely strong, commentaries have been very robust, the stock prices have not behaved, which in a way tells you that the sector is overowned and there is a lack of a marginal buyer. The other thought I have is possibly you could see some reallocation of money from banking to even IT, because banking is a big sector. You generally don't move money from a big sector to a very small sector. So banking has a 35 to 40% weight depending on which index you look at. In Nifty, it is at 38%. And IT is somewhere about 14, 15%. So if you want to move 200, 300 basis point of portfolio allocation, you might shift from banking to IT because IT is also a large liquid sector, which has significantly underperformed in the last 15 months. In fact, last year, CY22, NSE IT index was the worst performer with a decline of 27%. And PSU Bank was the best performer with a 71% rally. So I think IT is now entering into a zone where people who are underweight might look to reduce their underweight positions, and some reallocation of money can happen from banking to IT.
Got it. So what NBFCs? I mean, are you sticking with Bajaj Finance's and few others? Because I think insurance, etc., the non-lending financials are out of the picture when we talk about this phenomenon of peaking rates. So where is it that you guys as a house have favor?
So we have made one big change in our portfolio. We've added Bajaj Finance 3 weeks back when the price was about 5,600 in our model portfolio. So our logic for adding was very simple. The franchise is still growing at 25-27%. ROEs of more than 23%, and stock is available at sub 25 price to earnings. I usually, for a stable set of financials, look at PE also for companies which have not shown any balance sheet shock for last 1-2 decades. So company growing at 25% with 23% ROE available at a sub 25 P, risk reward to me looked favorable. So we added that. Commentary on the growth was quite solid as always, and execution on that scale. It's very difficult to find a franchise which can execute at that scale in India in NBFC. So we've added Bajaj Finance there in our model portfolio. Aside of that, we have some of the non-lending financials, as you rightly said, something like SBI Life, Angel Broking. So these are three, set of companies which we hold in our model portfolio. On the lending side, Bajaj Finance, and SBI Life and Angel on the non-lending side.
By the way, not from a stock perspective, and I don't intend to make it just a stock specific conversation, but since you mentioned it, does adding of a mutual fund business add significant zing to an online broker like Angel Broking?
Actually, if you go by the results of asset management companies for last 3-4 quarters, there seems to be a pressure on yield, right? And the growth per se has disappointed in that sense. With fullness of time, we will know how the execution of new entrants happen, because it's a very difficult business to build scale. Because you're competing with big, giant franchises which have very deep distribution network. So to attract money is not a given thing, and then performance has been very difficult to come by, especially in the last 2-3 years because of various geopolitical headwinds and so many disruptions which we have seen over the last 3-4 years on macro and micro front. So it is going to be a challenging task to build that business. So we will wait and see how it happens. But certainly, given the results of some of the established asset management companies in India, if you see those numbers over the last 4-5 quarters, there definitely is a pressure on yield.
Okay, Gautam, last couple of questions on autos. Just wondering, do you, there are some which are very volatile, there are some which are predictable slightly. So maybe Tata Motors falls in the volatile earnings category because there are a lot of moving parts there. Maybe commercial vehicle companies don't fall in that category. We're seeing fairly divergent commentary from the tractor companies as well. So where is it that you believe there is a higher probability of predictability of strong earnings and valuations looking comforting within the auto space?
So, Niraj, valuations are comfortable for every auto company today because
Okay.
these stocks have done nothing, pretty much nothing for the last 5 years. So, because profits have also not come, the profits of FY18 haven't yet come back in FY23, and market caps also haven't come back, barring one or two, maybe Mahindra and Mahindra is an exception. But most of the other auto companies are quite fairly valued, I would say. There's no element of froth which is built in. In fact, let me make a broader point. If you look at Nifty itself, the index valuation is at 18 and a half times, which is bang in line with long period average. Nifty was at 18,000 in October 21 when valuations at the index level were 21 times 1 year forward. Today, Nifty again is at somewhere about 18,000 only, but valuations are now 18 and a half times. So because of 1.5 year of time correction, and in the interim, your earnings for Nifty have grown by 13-14%. So valuations have become very, very reasonable for Nifty. The only pocket which continues to remain expensive is consumption. But even consumption relative to its own valuations 2 years back has come down significantly, right? Because there has been a massive time correction in some of the consumption stocks. So you saw Hindustan Lever's price today and February 20, which is 3 years back, is same. Nestle is trading at the same price in that same band over the last 3.5, 4 years. So valuation, to my mind, is not a big issue. The bigger ponderable is whether the earnings estimates, which are there, like I said, 2 year profits doubling. If that happens, you would see a substantial upside across the board on auto stock. Maybe two-wheeler will underperform given the lack of momentum on the volume side. But four-wheeler, commercial vehicles, things like Ashok Leyland, Bharat Forge, M&M, we have actually positioned Motherson Sumi as our top idea for 2023. Not the wiring one, the old one. So we are quite sanguine there, and index weight of auto has also come down to multi-year low right now at about 5.3%. At its peak, 6-7 years back, or maybe 5 years back, auto weight in index used to be 13-14%. So stars are getting aligned for auto after a long time.
Got it. My final question, Gautam, and that's on the internet businesses. They've been in the thick of things. There's some positive print from Paytm. Zomato has a lot of adjusted numbers to itself, and it's the talk of social media today. But I wonder whether, from a slightly a broader lens, or from not really from the 10 feet view, but from maybe a 25,000 feet view, if not a 50,000 feet view, do the internet businesses in India start to look attractive, or are you skeptical, or are you staying on the sidelines?
So we are on the sidelines, obviously, because we don't have a coverage right now. But the prices have come down. See, what has happened in many of these digital new age businesses is prices have corrected by 50, 60, 70%. But the market caps are still very elevated. And the quantum of the market cap at which these guys are trading, it needs justification in terms of cash flows and profits, which currently are lacking. But as you rightly mentioned, incrementally, the realization of becoming more profitable has dawned upon every listed company in the last 1.5 year. So at least you are seeing that the narrative and conversation which these companies are giving to investors, they are now mentioning and talking about profitability. This was lacking a year and a half back. So that's a very good progress. Second, just because you've seen 1 or 2 quarters where after some adjustments you are seeing some sense of profitability, do they become a big long-term, attractive categories? I have my doubt. Reason is very simple, because in the interim, your interest rates have also gone up by 200, 300 basis points. And that perennial dilemma of long duration cash flows, where your cash flows are coming after 3 years, 4 years. And when your rates go up in your basic DCF, the companies which gets hurt the most are the ones where cash flows are coming after a very long duration. So that problem still remains. But because they're so beaten down, even a minor positive news or minor positive announcement can see stock prices rebounding by 20-30%, which is what we have seen in the case of Paytm, which declared numbers and has announced profitability. I have not seen Zomato numbers, but I've heard that they've also talking and making progress towards operating profitability. But right now, we don't have a coverage and rating on any of the new age digital companies. We actually find the basic IT, the large cap IT itself, so attractive, with humongous cash flow and reasonably strong profit growth available at sub 30p. So we would be more biased towards the proven names which have a very well demonstrated track record of profitability, cash flow generation, and 80-90% payout ratios with 30-50% ROEs. So that is where our bias right now lies.
And viewers, remember, underperformance in 2022, which might add to that as well for 2023. Gautam, always good talking to you. So many numbers, so much to digest. Thanks so much for talking to us today. Really appreciate your time.
Thank you. Thanks, Niraj. Pleasure.
And viewers, thanks for tuning in.